Good morning, guys. So for this morning, we'll discuss about the time value of money. Now, this is a very basic and vital concept in finance and also in accounting. So in the future value of money, we say that the basic concept is that the value of your money today is not the same as the value of your money in the future. So here we're talking about two different time frames, that is today and the future. So if you go, what will be the value of my money in the future? So that is basically what we call the future value of money. But say for example, you would like to have an investment value of like 11,000 2 years from now. How much should you invest today? So that is going back today, meaning the present value of your money if you wish to accomplish a certain amount in the future. And you know for a fact that the difference between the value of your money today and in the future is what we call interest. Okay? So interest is the difference between the value of money today and in the future. Okay? Now, insofar as interest is concerned, we have two types. Okay, computing for the future value, it could either be a simple interest or compounding interest. Okay. So when you speak of a simple interest, this is essentially using a simple formula, that is your principal times the rate of interest times the time frame. Okay? And note that if we speak of rate of interest, unless otherwise stated in the problem, we will assume that the interest rate given is on a per annum basis, meaning that's for 1 year. Okay? Now, when you speak of compounding, this is actually an interest earning another interest. That's why we say it's compounding. The interest is actually compounding. Okay? Now, let's have an example. Assuming that on January 1, 2019, you invested 10,000 pesos. That earns about 5% interest for 1 year. Okay? Now, assuming that you'd like to know what is the value of your investment on December 31, 2019. So clearly we have 1 year time frame. This is 1 year. So therefore, using the simple interest method, this is simply computing the interest. So principal is 10,000 times the rate of interest, and that is 5% times 1 year. So therefore, that is roughly 500 pesos. 500 pesos is your simple interest. So if you speak of future value using simple interest, so that would be 10,000 plus 500 pesos, or 10,500. So this is now the value of your investment 1 year after. Now, what if we say you'd like to find the value of your investment, okay, on December 31, 2020. So here it involves 2 years already, right? Again, using the simple interest, we know that the 10,000 that will earn 5% is 500 pesos in terms of interest. So therefore, the future value now is 10,000 plus the 500 interest during 2019, and then the 500 interest during 2020. So the future value or the value as of December 31, 2020 would be 11,000. So simple interest, that would be the future value. But if we want to compute for the interest using the compounding, so we say that this is an interest earning another interest. So therefore, that would be 10,000 pesos plus the 500 pesos that we got for 2019. So therefore, the future value as of the end of December 31, so this is December 31, 2019, would be 10,500. Now, going 2020, now the new value, the new principal now is 10,500. So therefore, that would be 10,500 times 5% times 1 year is equal to how much? 10,500 times 0.05. Okay, the interest now is 525. So this is 525. So therefore, the future value or the value at the end of December 31, 2020 is 10,500 plus 525, or how much is this? That's 10,500, that's 11,025. Note that, okay, the 500 pesos, which is in simple interest, this is your interest on the second year, now becomes 525, okay? The difference of 500, or the increase in the interest of 25, sorry, that is the interest on the interest. That's the interest on the first 500. So that's, to prove that, that's 500 times 0.05, that is 25. So the 25 pesos here, which is the increase in your interest income, is essentially the interest on the 500, which is the first interest that you earn on your money in December 2019. So this is essentially computing for the future value of money. Okay, I'll be back to discuss about the present value.